The Golden Safety Net, a comprehensive guide to SPDR gold shares, GLD. As of January 26, 2026, the SPDR gold shares, ticker GLD, has solidified its position as the ultimate insurance policy for the modern investor. Following a historic 64% rally in 2025, gold has officially crossed the psychological $5,000 per ounce barrier this month, driven by a perfect storm of geopolitical friction, record-high global debt, and a weakening U.S. dollar. For an investor today, GLD is the most efficient gateway to the gold market. It allows you to participate in the bullion boom without needing a literal vault in your basement. However, investing in paper gold during a record-breaking rally requires a clear understanding of how the fund works, what is driving the price, and why 2026 might be a year of consolidation rather than another vertical surge. This guide breaks down everything you need to know before the opening bell. 1. What is GLD? The mechanics of paper gold. Launched in 2004, GLD was a revolutionary financial product. Before its inception, if you wanted to invest in gold, you had to buy physical bars and find a way to hide them. GLD changed that by digitizing the metal. How it works. Physical backing. GLD is a physically backed ETF. Every share you buy represents a fractional ownership, approximately 1/10 of an ounce, of a physical gold bar held in high-security vaults, primarily in London. Trust structure. The fund is structured as a Grantor Trust. It doesn't trade gold to make a profit, it simply holds it. As the price of gold in the open market, the spot price, fluctuates, the value of your GLD shares move in tandem. The Arbitrage Mechanism. To ensure the share price doesn't drift too far from the actual price of gold, the fund uses Authorized Participants, large banks. If the ETF price gets too high, these banks bring more gold to the trust and create new shares. If it gets too low, they take gold out and burn shares. This keeps the investment honest. 2. The 2026 Catalyst. Why gold hit 5,000? As we enter late January 2026, the golden bull is being fueled by three primary engines. A. The de-dollarization trend. Central banks around the world, particularly in emerging markets like China, India, and Turkey, are buying gold at the highest rate since the 1960s. They are intentionally reducing their holdings of U.S. Treasury bonds and replacing them with gold to insulate their economies from U.S. trade policy and potential sanctions. In 2026, 95% of central banks surveyed by the World Gold Council indicate they plan to continue increasing their gold reserves. B. Fiscal dominance and debt. The U.S. national debt is no longer just a talking point. In 2026, it is a primary market driver. With a $1 trillion deficit expected again this fiscal year, investors are treating gold as the ultimate opt-out. When the government prints more money to service its debt, the purchasing power of the dollar erodes. Gold, which cannot be printed, acts as a store of value. C. Geopolitical black swans. The start of 2026 has been marked by extreme volatility. Between the ongoing tensions in Eastern Europe, rising frictions in the Middle East, and the recent diplomatic disputes over Greenland and trade tariffs, the fear index is high. In times of war or diplomatic breakdown, investors flee to hard assets, and GLD is the most liquid hard asset in the world. 3. GLD versus physical gold. Which is better? The most common question for a new investor is, why shouldn't I just buy a gold coin? Both have merits, but they serve different goals. The case for GLD: convenience and liquidity. Instant trading. You can buy or sell GLD in seconds via your phone. Selling a physical gold bar often requires finding a dealer, paying a spread, the dealer's fee, and waiting for a bank wire. No storage costs. Storing $10,000 worth of gold at home is risky, and a professional safe deposit box can cost hundreds of dollars a year. GLD storage costs are baked into its 0.40% expense ratio. Precise sizing. You can buy $50 worth of GLD. Buying $50 worth of physical gold is nearly impossible due to the high premiums on tiny fractional coins. The case for physical: ownership and privacy. No counterparty risk. When you own GLD, you are trusting the trust, the custodian, HSBC, and the financial system. If the entire global banking system were to collapse, your GLD shares are just digits on a screen. Physical gold is in your hand and has no counterparty. Tangible value. For some, the psychological security of holding the metal is worth the extra cost. 4. Financial profile, understanding the costs. While GLD is cheaper than physical storage for most, it is not free. Key metrics, January 2026. Expense ratio, 0.40%. For every $1,000 you invest, Vanguard takes $4 per year to manage the vaulting and insurance. Taxation. In the U.S., the IRS treats GLD as a collectible if held for more than a year. This means your long-term capital gains can be taxed at a rate as high as 28%, rather than the lower 15 to 20% rates applied to standard stocks. No yield. Unlike a stock that pays a dividend or a bond that pays interest, gold produces nothing. It just sits there. You only make money if someone else is willing to pay more for it than you did. 5. Critical risks. The bear's case for 2026.
After a 64% gain in 2025, the biggest risk to GLD is profit booking. 1. The crowded trade. When everyone is talking about gold, as they are in early 2026, the market is often overbought. If geopolitical tensions ease suddenly, or if the Federal Reserve surprises the market with higher than expected interest rates to fight inflation, gold could see a sharp correction of 10 to 15%. 2. Opportunity cost. In a year where the S&P 500 might return 10 to 12%, and certain AI stocks are doubling, holding a non-yielding asset like gold can be frustrating. If the global economy enters a period of Goldilocks growth, not too hot, not too cold, gold historically underperforms. 3. The cheaper alternative. Many 2026 investors are moving from GLD to GLDM, SPDR gold mini-shares. GLDM is essentially the same fund, but has a much lower expense ratio of 0.10% and a lower share price. If you are a long-term buy and hold investor, GLD is actually the expensive version of the same product. 6. Investment strategy. How to build your golden anchor. The 5 to 10% rule. Most 2026 Fortress portfolios allocate between 5% and 15% to gold. It is meant to be the ballast of your ship, the part that stays heavy and stable when the rest of the ship is being tossed by waves. Dollar cost averaging. Do not put 100% of your gold allocation in today. With gold at 5,000, we are at record highs. Break your investment into 4 parts and buy once every 3 months to average out your price. Watch the real yield. The single most important metric for GLD is real interest rates, the interest rate minus inflation. When real rates are negative or very low, gold thrives. When real rates spike, gold usually falls. Conclusion. The ultimate insurance policy. Spider Gold Shares GLD is not a get-rich-quick stock. It is a bet against human error, a hedge against the possibility that central banks or politicians will make mistakes that devalue our currency. In the volatile landscape of 2026, characterized by high debt and geopolitical realignment, GLD serves as a golden anchor. The verdict. If you are worried about the stability of the dollar or the safety of the global financial system, a 5 to 10% position in GLD is the standard defensive play. It provides the peace of mind that comes with owning the oldest form of money in human history, with the modern convenience of an app.